I would like to invite now the moderator for the next session, Professor Carol Adams, who is a global voice on everything sustainability, even though she is Professor of Accounting at Durham University Business School. So Professor Carol Adams and her panelists. And the topic is very interesting. The topic is, do investors really know how to evaluate ESG risk? So that nicely sums up what we have discussed since this afternoon. The entire discussion so far, Carol, has been in the previous sessions that everything is now designed to feed what investors want from ESG or sustainability reporting. So it's over to you, Carol. And joining Carol and Madelyn on this panel are Michael Tang. He's head of listing policy product admission Singapore Exchange, which is SGX, our stock exchange here. Tim Daniels, head of investor relations and consultant at SM Investment Corporation in the Philippines, and Pratima Divgi. She is the point person for CDP in Asia. Over to you, Carol.
Thank you very much for that, Rajesh. And I will ask the panel members to introduce themselves at the moment. Well, we already know Madelyn, of course. But the panel, I want to really get to the bottom of what is this investor perspective that everybody is talking about. Do investors, what do they think they want? And do they really know what they want and need to make investment decisions? I'd like to invite, let's start with Tim then. Would you introduce yourself briefly, Tim? Hello.
Thank you very much, Carol, and it's nice to be here on this panel. So I work in investor relations representing SM Investments Corporation, which is the largest group of listed companies in the Philippines. We represent a little over 30% of the market cap of the Philippine index, the PSE. And within our group, we have businesses in retailing, banking, and property, as well as a number of smaller businesses like mining and leisure and logistics. So, we publish 7 or 8 sustainability reports covering our businesses. And we've really been on a kind of a 6-7 year journey driven by investors' requests for more transparency, which has gotten us to the point today where, we try to be leading advocates in the Philippines. And we've adopted GRI, the Global Compact, UN Sustainability Goals, and we're looking at how we can further develop it. And it's very much in response to a dialogue that we do have with investors.
Thank you, Tim. Michael.
Hi everyone, I'm Michael Tang from Singapore Exchange Regulation. We've been promoting sustainability reporting since 2011, and in 2016 introduced a mandatory requirement for companies to produce sustainability reports. Since then, we've been speaking to investors, banks, asset managers, insurance companies on what they feel about the state of reporting. So maybe in answer to your question, Carol, I could maybe give some inputs. I think firstly, it depends on the types of investment strategies or the types of investors.
Well, Michael, if I could just ask Pratima to introduce herself, if you don't mind. Thank you.
I'll wait.
We're all keen to get to the question, Pratima.
Thank you, Carol, and good to meet you all. Rajesh, appreciate the invite for the panel session today. I think for those of you who are meeting CDP or know about CDP for the first time, we started 2 decades ago. The idea was really very simple, to engage with corporates and understand what is the environmental impact that corporates have from their business operations and how aware they're of that. So we provide a reporting platform for corporates to report to on their environmental footprint. We then take that information, specifically with respect to climate change, sustainable forest practices, and water security, because water and deforestation are, in our view, a direct proxy of climate change. And we take all of that information and we give it to the over 560 financial institutions that request for this data from CDP, in the idea that then they will take this raw data and use it by engaging with corporates on that environmental footprint.
Okay, thank you. And Madelyn, thank you very much for staying with us so early in the morning. Did you want to add anything?
About my background? No, I'm good. Unless you
Okay,
want
thank you. Thank you very much. Okay, so let's get to the really.
May I back up? I want to add one thing about my background, and that is I was also the vice president and the treasurer of the World Bank, which is, in my mind, the best job I've ever had in my life, because I did a lot of work, in addition to my financial responsibilities, of helping countries mitigate and adapt to climate change and catastrophic risk, but through infrastructure, and I'm sorry, through structures in order to help them mitigate the financial impact. And so that's really where my passion comes, because this is so important. And I love the point that you just made about deforestation, because people just don't see the big picture.
Okay, thank you. So I've been struggling with this notion of an investor perspective that everybody keeps talking around about sustainable development, and this apparent demand for a small number of comparable and consistent indicators. Now, I'd have thought that investors might be interested in the risks around big sustainable development issues, and and what those risks present to an organization, and also how they're managing those risks, how they're incorporating them into strategy, how they're thinking about opportunities and governance oversight. So that's a more narrative type of disclosure and information. So I'm interested to hear, maybe from Timothy first, what is it investors are asking for, and what is it they should be asking for?
Thank you. Well, I think we should start out by acknowledging that there's many different types of investors. They're a hugely segmented industry, and we are seeing a general move across the industry towards more ESG and sustainability driven funds, which is driven by the people who give them the money to invest. And so you have a wide range of people who, like corporates, are also on a journey. So you have at the top end some really big names, of which BlackRock, for example, tries to be a pioneer with very high standards. And I will have conversations with them where they give me very specific feedback and say they would like to keep up a dialogue around that feedback. Then I've got other funds I deal with who, again, very strong, very responsible, and they're less in the evangelical, we're doing it for the good of the planet. We're not trying to necessarily deliver on all the sustainability goals. We're doing it because it makes good investment sense and our investors want it. And with those ones, the conversations are quite practical, and often it's clarifying the data, because they can get quite confused by what they're receiving from multiple third parties. And then there's a third category of investors I think of, where the discussions I have are more along the lines of, I have a team who looks at your data and looks at the third party reports, and they tell me that these are the couple of things that we should talk about. And that's a very focused conversation. Again, very good funds, very responsible, but they will more take a viewpoint of companies that are good at sustainability are good in general. They're good at many things, and they won't dive any more deeply than they need to get comfortable with that story. So I think it's a very nuanced answer. And as we look at evolving the reporting that we're doing and meeting the needs of these investors, we need to be very aware of the need to tell a story to them, because they don't, I get the sense from many of them, they don't want an arms race on more numbers. They want a clear story by which they can understand the company's perspective and how we're doing against those objectives. So moving to greater reporting standard clarity and perhaps simplification shouldn't be, I would suggest, more granular data and more analysis. It should be a way of synthesizing what's material to a company and how they are consistently going about delivering that. And that, I think, would meet the investors I talk to's needs in most cases.
That makes a lot of sense to me, Tim. Thank you. Michael, given that there are different types of investors, what's your experience there?
Well, quite similar, maybe to elaborate a bit on what Tim has said. I think you can see investors in a spectrum in terms of how much ESG information they actually demand in order to make an investment. You have the traditional, I would say, investors who do not give any consideration to ESG. But increasingly, you see more mainstream investors using ESG as a negative screening or as something that's integrated into their fundamental analysis on the portfolio. Moving on, you see those who look at the impacts of their investment and consider those impacts before making an investment. And of course, at the end of the spectrum, philanthropy, those who invest for a particular purpose. I think if you look at the different spectrums, you would see that each of them would demand different types of information and use different types of information, whether from the risk perspective, in terms of managing financial risk, or from the impact perspective in terms of measuring the specific performance of their investments from the impact perspective. Unfortunately, I think we do need to come back to the question of materiality, which we've been discussing a lot about. As financial markets, we are first and foremost a platform for investors to find information that will impact on their investments. And I think traditional analysis has been focused on financials, but increasingly we see more research showing that the sustainability performance of a company can in fact affect its financial and corporate performance, which is why I think ESG information becomes even more important and material from the financial perspective as well. And I think that is where I think in terms of maybe a consensus within the investment community, there's a growing consensus in terms of how to use the information. There's been development within great big asset managers of proprietary tools or usage of third-party tools, and getting the data, using it in portfolio construction or in their equities research. But on the impact front as well, we've seen the Global Impact Investing Network come up with a consultation in November this year, suggesting a methodology for how investors who are interested in impact investing can consider using a standardized methodology to assess their investments. So I'd say that there is growing consensus and work being done on how to use information, whether or not investors use it from the risk perspective or from the impact perspective really depends on the purpose of the investment. But I think underlying all these governance and strategy and understanding of how companies can sustain themselves in the long run remains a common denominator that all investors will need to take into account.
Okay, thank you. Madelyn, the data that investors are looking at, we're hearing that there's different data from an investor perspective, that's something different from impact on sustainable development. They've been separated out in documents, but how separate are they?
Can I just go back to answer a little bit on that, and then it segues into this question. And I would say you need to differentiate the kind of investors. You've got two kinds of investors, basically, the asset owners and the asset managers. I think it's fair to say that the asset owners, some of the large pensions, are really more walking the talk. I think many asset managers, unfortunately, are just talking the talk. One of our panelists mentioned BlackRock. Just last week, you can look it up, in Moral Money, they gave them pretty bad marks in terms of their voting record. I think, 11%, if I was correct. And, Columbia University recently did a study this past summer, and they showed that new signatories to PRI all of a sudden have increased AUM. However, no improvement on their ESG footprint. Actually, the funds vote less on environmental issues, and they experience more environmental controversies post-signing. And so their conclusion, Columbia University, not mine, is that you can charge more for an ESG fund. And so lots of people are piling into ESG funds, but are not really walking the talk. And then there was also a survey, RBC Capital Asset Management last year, of 800 of PRI signatories, and they asked a pretty fundamental question. To what extent are ESG principles being used as part of your investment approach? Stunningly, only 24% said significantly. And the rest of the respondents said, really not that much. So in terms of data, hedge funds basically were surveyed by KPMG. 63% of the hedge funds said that progress on ESG investment is totally hampered by the lack of any robust, reliable data. And so back to the data, one of the things that we're seeing is that a lot of investors now, and in particular, the more sophisticated investors, asset owners, hedge funds for sure, are using big data because they don't trust the reliability of the reported data. Because keep in mind, the reported data is self-biased, right? No one gives himself a bad grade. And one of the beauties about big data is it uncovers hidden risks that you don't get with self-reporting bias. And plus two, of course, big data is on a daily basis as opposed to, or even with intraday, because we have alerts about new information, which you don't get with self-reported data. That's obviously on an annual basis, and it's obviously unreported. So I think we have to really differentiate between the two types. And at the end of the day, there's no such thing in my mind as ESG, SDGs. SDGs is so broad. It covers all of the factors, environmental, economic, social, and governance. And it is all inclusive of any of the issues that are within ESGs. And I don't think we can look at, and as I mentioned in my keynote, how can you possibly think in this world today, especially with COVID-19, when we see what's going on, how, materiality only could be material to a company. Materiality, every issue is material to a company at the end of the day if it doesn't protect the planet. I always say when we talk about, many companies talk about, well, I care only what's material to my employees. Well, without an employer, there is no employee. So an employee can be happy all day long, but if an employer is contributing to deforestation and other issues that are really having a very bad environmental impact, then it doesn't matter how nice you are to your employees. So it's everything that has to be considered.
Thank you. So it's coming through very clear that there are very different types of investors and that the large majority of them don't really know what information they should be looking for and aren't really looking for much information at all. So thank you. So thank you for that. And it's curious then to talk about reporting from an investor perspective, I think, which, I'd like to bring you in now, Pratima, because I know the CDP's work, you're also interested in impacts on sustainable development and collecting data on that, which is what I would have thought investors should be really interested in, because those impacts on sustainable development, they feed back into whether organizations are going to be around in the long term, and also present risks to the organization in all sorts of ways. So could you tell us how, which of your CDP data is being used most, and what you think ought to perhaps be used most, and how is it being used?
Yeah, absolutely. And just to go back a bit to Madelyn's point, I think she made some very pertinent points in terms of self-reported data, because when data gets self-reported, obviously there is the inclination to put the best data forward.
Yeah.
Which is why when we have our reporting platform at CDP, we've divided, for example, the TCFD framework into 14 specific modules. Every company gets the same question. They've got to answer the same question. We don't verify data because we are not data verifiers, but we do ask a company, have you got your data verified by a third party? So an investor who's looking at the data immediately knows, okay, is this data being verified or not? But I think going back to your question, Carol, how are investors actually using the data, and the financial institutions that we work with, how are they focusing on the information that we provide them? And there's specifically sort of three broad areas, and this is where I come in from my previous financial background. three broad areas for any investor, asset owner, or asset manager. So number one is you are going to engage or monitor on your current investments. And when you engage or monitor, that's where your ESG stewardship comes in. This is where typically from a CDP perspective, we do have, just to give an example, CalPERS uses our greenhouse gas emissions data set to engage with the highest emitters in their investment portfolio. I'm sure BlackRock and others will have similar examples, and that's where Timothy, probably has a lot of experience as well. The second is, how do you use ESG information in investment due diligence? That is, at the time you're making an investment. And this is where things get a little shaky. And this is probably where, a lot of what Madelyn refers to also comes in, because in certain cases, the fiduciary duty that investors consider, they feel, is towards maximizing financial returns, in which case they may actually weigh financial returns higher than certain ESG metrics. Some investors consider financial returns on the same level as ESG metrics, and that's where they'll weigh in both decisions similarly. In certain cases, we have investment strategies drive the decision on the use of ESG metrics. So let's take the example of an asset manager such as IFM based out of Australia. Now they use the climate data information when they invest in infrastructure assets. And that makes perfect sense because infrastructure assets are very long-term assets. The implications of any financial related climate risk or opportunity should be feeding into an investment due diligence at that point. Where things start getting particularly shaky, in my view, in terms of ESG metrics, is when it comes to benchmarking. As of today, there's very little information which an investor can take a look at two companies from the same industry and say one is better than the other on the basis of purely ESG metrics. And I think that is where the question of simplicity and interpretation and being able to benchmark needs to really come in. And this issue is everywhere. I mean, even when companies are giving greenhouse gas emissions, reporting on greenhouse gas emissions, how is a financial investor supposed to look at that information from two identical companies and say, okay, this intensity metrics is better than this absolute metrics based on a certain time frame? That level of capacity building just hasn't come in yet, and that needs to be simplified. So that's sort of the investment due diligence sort of specifics and where things work well and things don't work as well. And then the third big part where investments come forward is in terms of new financial innovation. So you have green finance, you have social finance, and I think a lot of the financial institutions today really see the value of new financial products or ESG products and sustainability products, and that's sort of really taken off. We've worked with Amundi, for example, on a climate thematics fund last year. We have a couple other examples of banks who've used ESG or climate CDP's data to devise sustainability-linked loans. And we see that level of interest really coming in. Most times when financial institutions work with us, they're always trying to see how they can use the corporate data that we generate into new finance. But I think what really needs to be fixed is the investment due diligence part of things.
Okay, thank you. So, Tim, if I could bring you back in, because I want to come back to these stories that you talked about. We've heard that, from Pratima, that investors might have trouble comparing emissions data across firms. So I'm wondering now, where do these stories come in? Because I'd be interested in knowing about the management approach of the organization, the governance oversight of all of this, how it's setting targets and so on. And that would give me some context in which to assess emissions data. But I'm wondering, Tim, from your perspective, what are these stories that investors are looking for?
Thank you. it's the conversations that really make the difference with the investors, not the actual report, I find. And the better the report, then some of them are better armed with the facts and the data that we've shown them. But you know, in our case, we might arguably have come quite late to the day in doing sustainability reporting about 6 years ago, because you know, over the last sort of 6 decades, this company's been around. It's been growing in the Philippines, which is a country that is very much at climate risk. We're getting increasing disasters. We're getting rising sea levels. It's critical to our business to be as sustainable as possible. And that's the way the group operates and has grown. And I could give you many examples of the things that have been done, but that preceded reporting about it. And when we started doing sustainability reporting, initially it was a lot of, you know, here's what we're doing with mangroves, here's what we're doing with building disaster resilient buildings and investing in communities and seafronts and things like that. And we kind of got criticized a bit for not having enough data. So we really started improving. And of course, we get to the point now where, you know, I think we have some fairly thorough data that we're still trying to improve. But it's still the conversations with the investors about how do you think about the company's existential issues that will allow you to be around as a market leader 50 years from now. You know, that's the kind of question that I love having a discussion on, because then I can really talk about the operations of the group and how it has to encompass its stakeholders, how we have to factor in climate change, how we have to think about the things that are specific to the Philippines. And it's those conversations where you can talk about your risk management and your strategy and sustainability as all coherent and the same thing. That's where you make a difference with the investors, and they understand you a lot more than looking at, you know, last year's bar, this year's bar is bigger than last year's bar on certain numbers in certain reports. So, you know, it's really understanding the company's thinking and practical actions that is going to make the difference. And that's the conversation I prefer to have.
Thank you. So
Carol, can I just jump in here and make a comment to both of those, you know, very meaningful?
Yes, please do. And then I'll go to Michael.
Okay. So, you know, Pratima talked about, you know, how do you benchmark and how do you measure? And our other colleague just talked about this bar is bigger than that bar. That's always been my problem when I look at any of the sustainability reporting. So as an economist, I always say to myself, well, these are just numbers. And it's in numbers in the context of what? And no one seems to be, well, not no one. The UN actually has an agency, a research agency, is now working on contextualization, because you can report all the numbers in the world, even if we assume that they're correct, which they're not always correct, but in the context of what? And so I think that's one of the most, but that is the key thing that's missing. And then, of course, once you get that, then what's the optimal level? No one's talking about that. And so, and you have to look at the economic cost of the optimal level. So that's one of the beauties that I see with the global core indicators, because many of the numbers that you produce, you know, the SDG, ESG indicators, then are looked at relative to the company's net value added. So it's a percent. So you look at the total absolute number and then relative to its net value added. So why is that important? What is net value added? Net value added, if you add it up across every single company in a country, is GDP. And so now you can see what's the amount of CO2, for example, a company is producing relative to its value added, relative to the country's GDP. So I think that's a really important thing to look at. The other thing I would mention is, you know, this whole argument about, my fiduciary responsibility versus, you know, the ESG or SDG footprint. It's all about the data, and it's all about the portfolio construction. In fact, we have a top 10 SSRN, Social Science Research Network paper, top 10 in about 12 different categories now, that shows that using our data and the big data and using proper construction, we've created portfolios that have create alpha, beat MSCI index, and importantly, have a positive societal impact. So there is no controversy and there is no trade-off. It's all about the data.
Okay, so all about the data. Tim says it's all about the stories. And Madelyn, it's all about the context. So if I could come back to Michael then. So, you know, there is a big push for saying that we only need data, and it must be data that we can assure. But you know, I'm with Tim that the stories around what the organisation is doing and how it's managing it are also important, and how they're looking at their issues in context of sustainable development. What's your view about this type of narrative disclosure? I think Tim was talking more about meetings, but I think it does help if some of this is in reports as well. What's your view about that and how investors are or could use that information?
I think we should maybe recognize that when we ask for data, what we are asking for is really information on the company to understand more about the company. So this is a communication issue. What is the company telling its investors in terms of its business and how it's managing its risk? Data obviously provides an easy way for investors to compare, especially if it's standardized across the same benchmarks. But ultimately, an investor needs to make a decision based on more than just numbers, but on an understanding of the company and its governance. If we take a leaf from the whole initiative to enhance the corporate governance within companies, a lot of this information cannot be reduced to numbers, but rather it is something that investors need to get an appreciation and understanding of, not just through the corporate reporting that has been done, but also through engagement with the boards, with the CEOs and the CFOs of companies. So I would say that data is important, but perhaps more importantly, investors need to make an assessment of the company based on what it feels the board has been doing.
Okay, thank you. Now, I've taken us a bit over our finish time because we started a bit late. Rajesh, are there questions from the audience? Do we have any time to take them? Or should I ask members to summarize briefly any key last points?
I think you can go ahead to summarize, Carol, because and if there are some questions in the Q&A box, our panelists can stay back for a few minutes and type the answer if they like.
Okay, thank you. So, you know, we've got from this that there are different types of investors with different needs. There's a need to look at the sustainable development context. There's a need for data. There's a need for the story about the organization and how it's managing things. There's a question about whether it all goes in reports. And so I'd just like to ask each panel member very, very quickly, please, because we're close to out of time. If there's any one last reflection on this discussion around what investors think they need and what they should be looking at. We'll start with Pratima.
I think investors need to. Well, investors think they need more financial related data with respect to ESG metrics. And I think a lot of them are using it in some shape or form. Where I think the trick will be is how we start interpreting non-financial metrics in the health of a company and what we should be looking at in terms of the investment period that you're going to be holding this company for in relation to the investment ESG metrics that they have. That's number one. But the second one that I really want to point out is, at least in the case of climate change, there is a huge movement from the financial systems across the world with respect to understanding the financial implications. And I think at least as a priority, most financial institutions today that I'm aware of are rapidly trying to build capacity amongst their non-sustainability staff. So it's really just investment staff that's never looked at ESG before or climate change before, and seeing how they can interpret this financial data in relation to climate change. I would expect that level of capacity building to come in actually within the next 2 years or so. So I think that's certainly an area that we should be watching out for.
Okay, I worry that by focusing on the financial implications, they're not focusing as much as they should on physical risks, which will at some point come back to bite them. Tim.
Thank you.
Briefly.
You know, investors would never be able to understand your strategy by looking at your quarterly financials. They need the context of the discussion, and then the numbers tell you how you're doing. And I think it's the same thing in sustainability. You need to be able to explain where you're going and what's relevant to you and your context. And then the sustainability reporting helps them judge your progress on that. So I think there's an analogy. Right now, there's an awful lot of confusion about many of the reporting that goes on, and there is a need to help standardize. But I would say, let's not caught up in a false sense of security by having more data. Let's think about what's really relevant for a company to disclose so that you can understand its story. We're a little bit in danger of proliferating a metrics arms race. And I don't think that actually helps solve the problem that we're trying to do.
Yes, and falsely trying to work out which ones have financial implications, I think, too. Michael?
I think investors say that they want comparable, reliable data, but I think the devil is in the details. What we do need, I think, is to bring together investors, asset managers, to build that consensus, supported by greater academic research on what really matters and what are the data that they really need. And it is through those conversations that I think we can build better consensus on data usage.
Fantastic, thank you. Madelyn, the last word, very briefly, please.
Yep. Well, I believe Tim's point about engagement is, of course, correct. However, at the end of the day, it's not just about the storyline, it's about walking the talk. And that's one thing that we can see uncovering hidden risk in big data. The supply chain risks that they have introduced into the world, deforestation is a perfect example. So it's not just about more data, it's about consistent data, it's comparable data, and then it's robustly calculated. So it's not just about counting all the beans, it's putting it all together, but it has to be consistent and reliable. And what we find are enormous differences when you look at here's what they report and here's what we can uncover through unstructured data, reading hundreds of thousands of reports using 60 different languages with NLP. You find enormous differences. So obviously talking to companies is important, but no one would invest without really looking at the financial data, just listening to the storyline. They have to go together. But at least in financials, they are consistently reported on a basis of something that is
okay. Thank you. Thank you very much. Thank you very much, everybody. I think Rajesh is there to close us down. But thank you very much.
Thank you.
Well, Carol, I was enjoying this panel so much that I would love this panel to go on and on. I think we need to have more time for sure. But all good things have to come to an end, as they say. So this also has to come to an end. And I want to thank you, Carol, Madelyn, Michael, Pratima, and Tim for very refreshing. I'm telling you, I'm repeating myself, but this was very refreshing, very different from what we have discussed in previous panels. So thank you very much. And we hope to see you face to face in our 2021 summit.